honoured to be able to present at the Foundation for Auditing Research. I don't normally do a lot of auditing research, but this particular paper has a lot of implications, we think, for the way that management assesses integrity of, the auditors assess management integrity. So on behalf of Thomas Koich and Bill Mayhew and Thomas Steffen, my co-authors, we're really pleased and thrilled to be able to present here. What I plan to do today is just talk a little bit about why we think it's important to study integrity of management, and then define it, and then how we measured it in this paper. And then we're going to look at whether or not the integrity that we measured doesn't matter in terms of outcomes. So we look at employee perceptions, we look at auditor responses, and we also look at specific business outcomes. And then I want to just extend that a little bit into some more recent developments in this type of literature and some possible applications of the index that we developed. And I want to say up front, Jan was very generous in his interpretation of what we're doing here. We would not characterize it, I think, as a measure of dishonesty or that we're trying to, or that we can identify fraudsters specifically. What we can do, though, I think, is say a little bit about how a CEO's integrity measures up relative to other CEOs that face similar circumstances. And then it's a question of whether or not you believe integrity is of any interest to you in terms of the outcomes that you're seeking to investigate. So just in terms of how important integrity is, there's been some survey and field evidence. Certainly back in 2010, IBM did a very large survey of CEOs and what was the most important characteristic of the types of CEOs or that CEOs should have in leading a company. And integrity was the second most important behind creativity. And then more recently, we've seen some academic research in the field and also survey-based research that looks at how important integrity is. So this particular paper by Graham, Harvey, Popodak and Raj Kapal, they show that integrity is valued by investors and that the current CEO plays a very important role, and their integrity plays a very important role in determining corporate culture. So some more anecdotal type evidence. Warren Buffett is very stresses the importance of integrity and suggests, as we say in the paper, that from a quote of his, that intelligence and energy are very important for management, but if you don't have integrity, then the first two will kill you, as he points out. And then we've had discussions with board members and also CEOs, and inevitably what happens when we talk to these type of people, the suggestions of integrity in terms of the CEO is really important for firm value. In particular, boards tend to have weaker information and need to rely a lot on trusting the CEO. And so picking a CEO with high integrity is critical. And boards seek someone to develop the right tone at the top, and that can build the right corporate culture and enhance shareholder value. However, given this survey type research and anecdotal research, we've noticed at the time we started this paper, which was back in 2012, that integrity was not a focus in the accounting, auditing and finance literature. So what are the reasons for why we have not seen a lot of literature on integrity or measuring integrity? It's a soft characteristic. So we firstly have to figure out if we can define it in a way that could be measured. Secondly, we have to look at whether we can measure it and whether we can agree that the measurement captures the key elements of the concept that we're trying to measure. And ultimately, does it really matter? So can we develop falsifiable hypotheses about whether integrity has outcomes that are of interest to auditors and to management? So in terms of whether we can define integrity, we apply a definition of behavioral integrity. which comes out of the organizational science literature, and ultimately it boils down to perceived word-deed congruence. So I'll talk more about that in just a moment, but this is just at the high level, a preview of what we do. Can we measure it? What we do is that we take a new measure which is based on the abnormal number of causation-related words that CEOs use in their shareholder letters. And again, I'll talk more about why we used causation-related words, but the short story is that causation-related words relate to explanations, and our conjecture was that the more that CEOs over-explain relative to other CEOs facing similar circumstances, similar news, then those over-explainers tend to be ones that are not trusted by the market and are less credible. So does it matter? Our measure of low integrity is associated, and again, this is just high level, and I'll get into the details in just a moment, associated with unfavorable employee perceptions. It's associated with higher audit fees, bad tone at the top in the early years of investigating tone at the top, and also options backdating, stock options backdating. And then it's also associated with lower Tobin skew. So there is an element of future financial performance that's associated with poor integrity. And one of the key things that we found in our paper is that the higher audit fees that tended to be generated associated with this low integrity seem to be associated also with preventing accounting outcomes. So we actually don't find a lot of instances of material misstatements associated with low integrity because we believe that the auditor was an effective intervention. So the auditor assesses management integrity and is able to perform more tests, and as a result has higher audit fees. So just in terms of structurally what we look at a conceptual level, we're interested in this idea of management's integrity and specifically the CEO, their behavioural integrity. And I'll talk more about what behavioural integrity is in just a moment. We look at the outcomes in terms of stakeholder perception, so employees and auditors, stakeholder reactions, so we look specifically auditors, and then business outcomes. And then to look at how we operationalise these conceptual measures. With behavioural integrity, we're going to take the residual from a regression of the shareholder letter causation words, right? And then we regress that on all the things, all the factors that could create a demand for those types of words in the shareholder letters. So anything to do with the news about the firm characteristics, the CEO characteristics other than integrity. We try to pick up all the things that could determine the use of causation or explanation type words. And then what's left over, we're interpreting as a very noisy measure of integrity. And then we look at how that's associated with perceptions from employees, auditors, the effect on audit fees. And then we look specifically at outcomes associated with fraud and the bankruptcy score, as well as whether the CEO got sued, and option backdating, and then Tobin skew, which is the future financial performance. And for each of those outcomes, we look at established determinants already. So we're looking at the incremental effect of this behavioural integrity factor that we're able to pick up. So in terms of defining integrity, we started with just a dictionary definition, the quality of being honest and fair, and so our paper often gets interpreted as being one that picks up the honesty of the CEO, and this idea is associated with the notion of integrity. However, what we noticed as we were going through the process, and as I said, we've done this been working on this for 8 years essentially, we realized that it's more about whether or not the CEO acts in the way that he or she says that they're going to act. So in other words, it's a perception of the alignment between the CEO's words and deeds. So it's perception by some counterparty And we assume in the paper that everyone knows, has a fair indication or perception of what the CEO, the ones that have interacted with the CEO, what the CEO's behavioural integrity is like. And then we rely on this paper in Simon's, in organisational science, who defines the notion of behavioural integrity. And Simon says that CEOs who have high behavioural integrity are more trustworthy and therefore need to give fewer explanations, and that's key for us, fewer explanations to justify their behaviour. So we really rely on that, and then we look at what the CEOs actually say in terms of their explanations. So how do we measure it? And we considered a lot of different potential ways, and what we ended up focusing on was shareholder letters. And we picked shareholder letters because they're less regulated than other types of communication. So there's no, well, there is to some extent lawyers involved, but they're not as involved in the shareholder letter as what they are in, say, the MD&A. And the letter is actually signed personally, typically by the CEO. It focuses on the performance of the firm, and so we can filter out all the news that is related to the MD&A. And the conference calls is an alternative source that we could have used, but that requires the firm to be followed by analysts, and we wanted to be broader than that if we could. So we do use conference calls later to rule out the possibility that the behavioural integrity is from someone other than the CEO, and I'll talk about that. But we found that this was a useful source. And to give an example of a shareholder letter, this is an excerpt from a letter that Jamie Dimon wrote, and he talks about striving to share the truth and honest assessments of the business, that they're going to act with integrity and honour, and so on. And Jamie Dimon's letters, some characteristics of those letters is that he writes his own and is well known to writing his own letters. They're very different from the letters of the predecessors of the bank. They also contain the same principles regardless of the company. So extending over different types of companies. We're interpreting this as more of a CEO fixed effect, although it does seem to vary with time, at least operationally. But with respect to Jamie Dimon's letters, his is very blunt and revealing. This is unacceptable to us and to our shareholders, so he's very blunt, more so than what he would be in a MD&A, and he's been viewed as someone with integrity. And you might disagree with him and his policies and his politics, but his performance has been relatively strong for the organisation that he runs. We got a lot of pushback in the review process about whether or not the CEO actually writes the shareholder letters. And so one of the things that we did to try to alleviate some of those concerns is to survey investor relations professionals. And so we're able to send out a survey and ask about over which document the CEO has the most influence, and 91% said the annual shareholder letter versus the MD&A. And then we also asked, on a scale of 1 to 5, being no involvement to highly significant involvement, how involved is the different officers with the annual shareholder letter? And we showed that as you might imagine, the investor relations officer is highly involved with the annual shareholder letter, but of course so is the CEO. And it's not significantly different, the amount of emphasis between the investor relations officer and the CEO. It is very different from the CFO, the legal department, and the Treasury and Finance department. We asked the same question with respect to MD&A, and the CFO is highly involved in the MD&A, as is Treasury and Finance and legal. CEO, not as much, and significantly different from the CFO, Treasury, Finance, and legal. So the CEO delegates it to the finance professionals. So we got some comfort out of that in terms of the annual shareholder letter at least, one, that the CEO tends to be heavily involved, and two, their level of involvement is quite different relative to their involvement with the MD&A. So in terms of the empirical model, we take 30,000 shareholder letters that we downloaded, and we regressed the number of causation words. We counted the causation words, and we regressed that on the number of causation words in the MD&A to filter out information about the firm, as well as a bunch of other demand proxies. And at the end of the day, the residual is what we're interested in. This residual, if it's a low number, we interpret that as higher integrity. If it's a high number, we interpret it as low integrity. Okay, so in terms of the measurement of integrity, the causation words that we pick up is from a standard dictionary initially. So we literally counted the number of causation words in 30,000 shareholder letters, and the causation dictionary has the words products, product, results, production, etc. All these words are in the dictionary, and products is the most frequent word in the dictionary. What has that got to do with explanations? Well, remember these LWIC, this is a standard dictionary in linguistics literature. These dictionaries have been developed for non-business contexts. So one of the first things that we did was to refine the dictionary to try to make it more applicable to a business context. And so we looked at a number of dictionary deletions. So we took a random sample of 5,000 sentences. We searched every one of the words in the top 98% of causation words. We searched that in the 5,000 sentences, and then we subjectively and independently assessed whether it represented some sort of explanation or rationalization. And so we did that for deleting words from the standard dictionary. And we also did a random sample of 5,000 sentences, and for each word, we isolated every sentence containing a word that could be construed as being an explanation. And we ended up adding some words to the dictionary as well. So to give you a flavor of that, turns out that in a business context, products, product, and production mean a very different thing to what they do in a more general linguistics context. Same with solutions, sense, and leadership. So we removed those from the dictionary. And then in terms of adding words to the dictionary, the word through was a very important word that seemed to have some connotation of explanations. The word support was another one, and the word provide. So we added those words, and we can see that through ended up being the most frequent word that was in our revised dictionary that was related to explanations. And so we've got this dictionary of words related to explanations in a business context, and we use that as the starting point for our regressions. And this is what the determinants regression looks like. So on the left-hand side of the regression, we're taking the number of causation words in the shareholder letter, so shareholder letter causation words, and we regress that on performance variables, uncertainty variables, complexity, how complex the firm is, whether there's data conflict, some CEO's personal characteristics, and then impression management characteristics, which come out of the literature that Feng Li had started on the readability and fog index of reports. And there's been a bunch of literature since then that looks at linguistics of reports, annual reports, and we've controlled for a number of those variables as well. And we can see they're all significant. And so we're trying to filter all those away. And then the most important one, we think, is this MD&A causation words. So we're trying to filter out explanations related to how well the firm has performed. And so that's our determinant model, and we take the residual as being a noisy measure of what we interpret as integrity. So some examples. Joseph Naccio was in our sample in 1998, only in 1998, and he was in the 85th percentile of low integrity. So the higher the number here, the lower the integrity, going up to 100. And under the more standard dictionary, he was in the 85th percentile, and under the refined dictionary, he was in the 85th percentile, and he was convicted of insider trading in 2001. Richard Scrushy from Healthcare South, he ultimately initially beat some convictions of fraud, but then after he beat those convictions was immediately some charges were laid against him for money laundering, extortion and obstruction of justice with the former governor of Alabama, and ultimately was convicted for 6 years. Now, Scrushy was in our sample as well. Under the standard dictionary, we can see that there's quite a bit of variability there, but with the refined dictionary that we developed, we can see that the measure is a little more consistent and shows Mr. Scrushy in about this nearly the 80th percentile of low integrity. And then just to show that it's not a perfect measure, or actually this actually helps to show the strength of the measure. Senegal, he's a Costco CEO, so he's a measure of high integrity. He was in the sample for 10 years. Under the standard dictionary, it varied quite a bit, but with the refined dictionary, very consistently, extremely low numbers here, suggesting very high integrity, does not need to over-explain. So just the market trusts what he says is very credible. But the example I was going to give that shows that this is not a perfect measure is the Target CEO. Back in 2014, Target did not say anything about the leakage of personal information or personal data. Did not look so good in years 9, 10, and 11 in terms of integrity, the CEO, but even under the refined measure, it seemed to improve dramatically in 2012, right before this leakage happened. So it's not a perfect measure, but it's on average, we think it does a pretty good job of filtering out some of that noise. So does it matter? And we look at this in multiple ways, and we show that there's going to be unfavorable employee perceptions. Prior to 2006, there's going to be tone at the top qualifications from auditors, and then higher audit fees, no effect with respect to AAER misstatements, or the no effect with respect to the F score or whether or not the CEO gets sued. And but it is associated with lucky stock options. So in other words, backdating of stock options, and low integrity is associated with lower financial performance, future financial performance, that is. So in terms of perceptions, this is one of my favorite parts of the study. We actually had a small sample as well, independent of the large sample that we worked with. We got this from a consulting firm where they measured the integrity of CEOs directly. They asked questions that specifically about integrity of the CEO and also of the employees of the CEO. And they had 84 CEO respondents. Unfortunately, we only had 10 that were overlapping public companies that we could do later analysis with. Of those 10 public companies, there were 327 employee respondents, and they were asked 12 integrity-based questions such as, does the CEO do what they say that they're going to do? And so on. There were 11 other questions. And the CEO's employees answer the same questions as the CEO as well. So we've got multiple measures of this. And what we find in this small sample with only the 10 observations is that there's an extremely strong correlation with our linguistic score. So in other words, the low integrity CEOs matched up with, so they're the ones with the higher causation scores, they matched up with the integrity scores that came out of this small sample. So I think the R squared was over 90%. So very strong correlations there. So it was a way that we could to validate that the measure that we were getting was actually an integrity score that was valid. And then we looked at employee perception. So we went back to the large sample, and we're able to get employee perceptions of CEOs from Glassdoor. And we measured that in 3 different ways. And so what we're able to show in one of the initial tables here is that our integrity score, we call the LINT score, which is low integrity. So low integrity is associated with the low integrity as measured by KRW, which is our consulting firm that we got the information from in the small sample. And then we did a factor analysis type score, and we show the same results there with the small sample. So these are only a sample of 10. But then we looked at the bigger sample with the CEO scores out of Glassdoor, and we showed that CEO ratings are lower, the workplace ratings are lower, and also workplace sentiment. So the difference between positive and negative words is lower as well for low integrity CEOs or higher LINT scores in this case. So that's one of the initial results that we're able to show. And then with respect to auditors' response, we showed before or just after the SOX came in, there was weak tone at the top if there was an unethical work environment, and there was 2 codes that were available there. And we showed that in the 2004-2005 years, which is just after SOX was imposed, auditors would identify relatively more tone at the top issues, and we show that that's linked to our integrity score. And then subsequent to that, the results went away, but we think that's because the auditors did more work to help the clients overcome some of their internal control issues. And then our main result with respect to audit fees, we can see here that the audit fee is related to our integrity score, so lower integrity, higher audit fees. And when we don't control for anything, when we control for year and firm's fixed effects, and then we control for year and firm fixed effects, and all the other determinants of audit fees that we've seen in the literature, and we've got an R-squared there of 95%, so it's hard to make a case that there's correlated admitted variables there. So this is the more detailed determinants model of audit fees. And you can see we control for Big Four, non-Big Four auditors, the size of the firm, the complexity of the firm, and so on. There's just a whole list of different characteristics that we've controlled for there in terms of audit fees. And we show a very strong, robust effect that it's audit fees are higher when we've got a low integrity CEO. So the auditor recognizes it and they do more tests, is our interpretation here. And to show that this is not just a firm-related issue or characteristic, and that it's related to the CEO, we looked at conference calls. So it's out of sample type test here. We looked at conference calls. We measured causation-related words used by the CEO versus the CFO. And if it was a firm-related use of causation or explanation words, we wouldn't expect to see much difference between the CEO and the CFO. And in fact, they use roughly, in fact, the CFO uses more causation words than the CEO in the conference calls. And we showed that how they're correlated with the integrity score that we have, the CEO's conference call causation scores are very highly correlated, whereas the CFO conference call scores is not correlated at all if you control for that. So we took this as being that the measure that we're picking up is a measure that's related to the CEO, which is really critical to the way that we're interpreting this. And then with respect to firm-related outcomes, stock option backdating, we do the typical tests that look at lucky stock grants, where we look at stock grants that were given at lower stock prices so that the CEO can benefit from it. And then we also look at future performance outcomes. So we rely on this literature that talks about corporate culture and how better corporate culture is associated with positive future outcomes. And the Graham paper talks about the mechanisms by how that might happen. And so to what extent does the CEO influences corporate culture? The Graham, Harvey, Rajkol and Popodak paper suggests that it's very highly correlated. And so to the extent that it is, we might expect to see a positive effect or a negative effect for a low integrity CEO, positive effect for a high integrity CEO. And in this test of outcomes, we see exactly that. So low integrity CEOs have lower future performance. We can see here, I'm circling there. Associated low integrity CEOs are more likely to have lucky stock grants, so backdating stock options. But we don't show any effects with misstatements and the F score, so bankruptcy, and also the sued, the probability of being the individual or the CEO being sued. And to the extent that the auditors do intervene and prevent these sorts of outcomes happening, we're arguing that the integrity is known by the auditors and they make adjustments accordingly. And then in terms of recent developments and possible applications, there's a paper that's actually used our data. So this paper is published in Organizational Science. We shared our data with the authors, and what they do is that they look at organizations that seem to have employee-friendly firms, and banks tend to favor them. And so they make the argument that these employee-friendly firms are screened by banks, and they tend to have more favorable treatments by the banks, and they get lower cost loans. So we shared our data, and it turns out that to the extent that CEO behavioral integrity is associated with better treatment of the employees, so we show in our paper that there is a link there. So high integrity, better treatment of employees, and employees are more satisfied, and the opposite for lower integrity. Then high integrity CEOs are associated with lower cost loans. And so it implies that the banks screen on the intent of the CEO when they provide debt financing. And then a more recent paper, also very recent, that does not use our particular method of measurement, because they take a very different approach, but it's the same sort of idea. They're using machine learning, and I think this is the way that this is going to go in terms of trying to measure a characteristic at a distance from speech patterns. I think this is the way we're going. We're going to get into machine learning, and this particular paper develops a corporate culture dictionary out of 200,000 earnings call transcripts. They apply it to more than 60,000 firm years, and they show that the corporate culture measure that they develop, and integrity is one part of that, is associated with operational efficiency and all these different outcomes: earnings management, executive compensation design, firm value, and deal making as well. And it would be interesting, we haven't done this yet, but it would be interesting to see how well we correlate with their particular measure from machine learning. And also another recent development, we had a consulting
firm. We are a little bit...
Yeah. Over time?
Yeah, we get a little bit over time.
Okay, just really quickly, we applied this to the DAX 30, and we showed that our measure of integrity doesn't pick up much, but the lying measure does pick up Wirecard very clearly the year before they had the major fraud there. So some possible applications, which I think will probably come up in the discussion. So just to summarize then, is it consequential? Our measure seems to suggest that it is, just in terms of the auditor perceptions and the reactions, and in terms of firm outcomes. Thank you very much for the opportunity, and I'll hand over to Marnix. Thank you, Marnix, for taking the time to read the paper.
Thank you very much, Shane. And indeed, we take it out to myself. Many questions already in the chat, so I'm looking forward to a lively discussion. Marnix, the floor is yours.
Very good. Well, first of all, thank you very much, Shane, for that wonderful presentation. I've read your article and research paper with great interest. So during this discussion, I would just shortly want to reflect on this article and also put it in the perspective for me as a young audit professional working in the audit practice. And when I read the article, I remembered a recent experience that I had, which was actually with an audit client of me, where we already had for years, I had some doubts about the integrity of the CFO. And it was more based on the gut feeling. It was about the transparency that he didn't give actually, in specifically in the accounting estimates context. So, but that was just a gut feeling. And then recently we noticed that they hired a new person for a finance position. And when we did our background check, we actually identified that person to being accused of being involved in questionable transactions. So when we asked some questions internally within the organization on that, so what happened there, or were they aware of that, they were a little bit like hesitant to answer the questions, and they ultimately referred back to the CFO and the CEO. So when we, of course, asked and followed up on that to the CFO, they mentioned that they were aware of the fact that that person was being involved in questionable transactions. And that, of course, triggered on our side for the audit all kinds of questions with regards to the integrity of, well, of course, the new finance person, but also, of course, from existing CFO and CEO. So we then insisted on having an independent investigation being performed. And of course, we involved fraud specialists from our end as well. And that ultimately led to additional audit procedures. And of course, that also led to additional costs, which we were able to recharge to the client. So I think it's an actual evidence and a case which supports your research paper that a low perceived behavioral integrity of the CEO leads to more audit work. So that was a recent experience that I wanted to share just when I was reading through the paper.
Thank you.
And maybe also putting it in perspective in let's say, in a broader audit. I think this is a very important topic, but it's also a difficult topic. And if I can speak from my experience, we base our judgment on the integrity of the CEO and the CFO, basically based on the combination, I guess, but that's just my expectation based on the audits that I'm working on, based on, let's say, our gut feeling, so the discussions that we have with the CEO and CFO, and of course on more objective and hard signals and red flags. And then, of course, we act upon those, just as in the case that I just mentioned. I think we mainly act on, let's say, objective signals as how transparent is management towards us in discussions, or does management is happy to, well, make corrections in the financial statements? Do we flag any signals in background checks or anything like that? And I think it also, the response to that could also very depend for each audit. So I think that we currently do not have, let's say, a framework or a systematic way in our audits that we assess the integrity the CEO's integrity on. And I think that will be, at least from my perspective, be very interesting also for us as an audit profession to learn and to know if there's such a framework, or that we are able to more objectify this in our audits, and then have some tailored responses to that for our audits. I think that will help us in two ways. So first of all, I would say that will help us in the client acceptance process, because in the client acceptance process, you have, of course, had limited interaction with the CEO and CFO, only some discussions probably. But I think if you have, let's say, an objective measurement of how to measure the CEO's integrity, then we are able to maybe also take measures from a system of quality control perspective. So putting another independent review on it, or maybe don't even accept the client at all. So that's the first of all where I think it will benefit us, but also on the other hand, that will help us during the audit process. So maybe that it makes us aware of that we need to be more skeptical when we evaluate management information, or identify more higher risks, or maybe even involve fraud specialists. And especially integrity is so related to that fraud topic, and our stakeholders expect more of us in terms of fraud. I think that's very important for us to, as a profession, to learn more about. And that brings me also to my question, Shane, before we open up the Q&A. So your study or your research shows that when we perceive the CEO integrity, or to have a low integrity, that leads to more work. But if it would be the other way around, so if we perceive to be the CEO's integrity to be very high, do we then also perform less audit work? And I know your research is not on that question, but can you reflect on that? What you expect to be the case?
So, I mean, mechanically, the answer is yes, but I think practically that I don't think that would happen. I think practically what would happen is that the auditors would typically do their background checks, and they, if it's a brand new CEO, for example, they might search press releases and do the types of work that they would typically do, and then I think that this measure could supplement that, and supplement it in a way such that if there is a red flag, or if the low integrity is indicated, then you would actually do more work than what you would typically do. So yeah, the way that the regression is set up, it mechanically would look that way, but I don't think that an auditor would do less work. But I'm not an auditor, so maybe I'm the wrong person to ask. I mean, if you, maybe I could ask you, if you got an indication from some machine learning algorithm that there was a potential low integrity CEO in place, what would your gut instinct tell you? Would you do, or sorry, if it was telling you that it was a high integrity CEO in place, what would your gut instinct tell you? Would you do less work? I don't think so. I think you would do the minimal amount, right?
Yeah, no, I believe so as well. But I think just in the current way how we perform our audits and how we perceive the integrity of the CEO, we don't have that objective measure. So we act based upon, I think, our gut feeling mostly. So I think it would be, it is, yeah, quite of a risk from an auditor's perspective when we perceive, like based on discussions with the CEO or CFO, to be very integer, but then on the other hand, maybe be less skeptical when we perform our audit procedures. Maybe that's just a bias, right? And I think that could be a risk from an auditor's perspective. But in case you are able to objectify it, and I think you would at least perform indeed the minimum audit procedures that are required to do so, as you suggested as well. So maybe we can continue with some of the questions from the Q&A, and I saw that there were quite some debates and questions on the way you've measured the integrity of the CEO.
Okay.
So the first question is about, to what extent does the letter to the shareholders actually reflect the CEO traits?
Yeah.
So is this not written by communication team, including text editors?
Yeah, that was and by a second question. We said, you know, these letters are actually written by a PR team. So it's actually not CEO writing this.
Right, and so we were concerned about that. We got pushback in the review process about this specific issue, and so that's why we surveyed investor relations individuals. And so, I mean, we've got a sample of 35, and you might argue that's not a very large sample, but there's also, and there's anecdotes that tell us that the CEO doesn't actually write the letter as well, and so to the extent that the CEO is not writing the letter, then it undermines what we're trying to do. At the same time, the survey evidence suggests that the CEO is fairly heavily involved. So they might not write every word. The investor relations person may draft it, but they ultimately sign it. And so they care about what's said in that letter on average, right? And in fact, we show 91% of the CEOs have a fairly heavily involvement in our sample. And then to the extent that if it didn't, the CEO didn't have anything to do with the shareholder letter, then there's no way that we would get the results that we're getting across the different types of different outcomes. So there would have to be a pretty unusual story to try to satisfy an alternative explanation, I think.
Yeah. So another question coming in, and Christian asks, so given your measure of integrity going forward, won't a low integrity CEO who wants to mimic a high integrity CEO simply use fewer causation words in his or her shareholder letter? And I think you also addressed that a little bit in your article. So maybe could you reflect on that?
Yeah, so I guess the initial reaction to that is I don't know if the CEOs would know enough about our work to actually change their behavior. Like, so they could try to remove the number of causation related words and use fewer explanations. But one, they've got the market that's disciplining them, right? So they might not be able to, especially if they're low credibility. So they might not have a choice, and they have to give explanations. And you know, they might try to game the system such that they don't use the words that are in our dictionary. But I just don't think that they look that closely at work that we do. And ultimately they may. And I think though that the next phase or version of this type of work is going to get into machine learning algorithms rather than the more manual process that we did. Because remember, we started this in 2012, and now machine algorithms, learning is starting to take over. And I just don't know if, well, maybe CEOs might have a machine learning algorithm that could learn the machine learning algorithms of academics. I don't know. I just don't know if they will go to those lengths and whether it's worth it. Yeah.
All right, and I see there's also coming in a more specific questions for the details. So the question is, it's just a minor one. So why is since removed? I think it was from the dictionary list. So doesn't it also provide an explanation similar as due, which is included in the list?
Yeah, we found since was mostly used for, since 1944, this has happened, or since 1994, this has happened. So it wasn't used in the context of an explanation. There were some, but we would have to go through and try to pass them out. And what we were finding is the majority of them was very much just related to a date and not related to an explanation.
Yeah. All right, I see another question coming in. So have you also considered looking at the interaction between the CEO and CFO traits? So for instance, I can imagine that the impact of a low CEO integrity is weaker when CFO integrity is high. So a technical point, so you might even look at the impact of incongruence of these traits with polynomial interaction terms. That's a difficult word.
Wow. So that's something we haven't done at the moment. Part of the reason why we haven't been able to do that yet is because there isn't a standard text for CFOs in the way that there is a fairly standardized text in terms of the CEO shareholder letter. And so it's more difficult for us. I mean, people were worried about whether the CEO wrote the CEO letter. Being able to say whether the CFO wrote a particular standardized corpus would be even more difficult. Now, we could go to the conference calls, and we did do this very crudely when we were trying to dismiss firm complexity as an alternative explanation. But that has wide variations in the amount that the CFO speaks. So some CEOs let the CFO speak a lot, some CFOs do not. And so it's difficult to get a standardized level that we could measure for the CFO. So in other words, we just can't get a very good measure of CFO integrity from our sample or from, I think, any publicly available sample at the moment. Now, that said, I've actually worked on another paper that looks at whether or not the CFO is appointed after the CEO, and we show that that's related to higher CEO compensation. And so that's a very crude measure, but I think it gets at a little bit of that idea that's being suggested here. And I think it's a really interesting idea that can be explored more. It's just trying to think of creative ways to measure this is the challenge.
Yeah. So there's another question coming in. So is it possible to validate the CEO integrity measure with actual high-profile misconduct records from audit analytics database? And there's also a reference included to, I think, another study on that.
I'm not sure what's in the audit analytics database on misconduct, but to the extent that there's misstatements, we showed no effect. And so our interpretation is that the higher audit fees meant that the auditors did more work to prevent the misstatement from happening. Now, whether or not the misstatement was intentional or unintentional is not something that we can get into, because we just don't have the data to be able to do that. And I don't know if the audit analytics could actually tell us something more than we already know. We're pretty comfortable that it is related to the CEO. At least the measure, whatever it may be, if it really is behavioural integrity, if it's some other characteristic, it doesn't seem to relate to fraud directly. And so some might view that as a negative. I view it as a strength. It says to me that the auditors are actually doing a preventative, or playing a preventative role when they see a low integrity CEO, and just in the way that you described, Manix. And I think that's really important. And so, yeah, I don't know how else that we can address that, actually, just based on what we have.
Yeah. And I think there was an interesting question coming in, and I think it's very relevant to the current state we are in as auditors and the current or the recent news articles. So could you elaborate a little bit more on what you found for the DAX 30 companies and Wirecard?
Yeah, sure. Actually, let me just re-share this again. Oops, I lost it. I'm going to share my screen again. So we had, there we go. So we looked at the DAX 30. Some consulting firm asked us to apply our causation score to the DAX 30, 30 largest German companies. And what we found was, I mean, it's a pretty intensive data gathering process. And so all we were able to do is to get the shareholder letters of the top 30, and we looked at 2 or more years. So the ones where we suspected there were some issues, like Volkswagen and Wirecard, we went back in time a little further. So that's why we've got 68 here. And then what we did was we applied not only the number of causation words, but we also looked at the other impression management variables as well. And so we didn't get the integrity score because we need all of those variables that would determine the causation words and then save the residual. And so we stopped at just simply counting the causation words. So we have not filtered out the effect of information. So this variable here doesn't really tell us as much as what we would like, or as much as what's in our current study. And so we haven't taken it any further at this point. But what was interesting is some of the other impression management variables were quite interesting. The Wirecard in 2017 measure is negative for lying, which is one of the impression management variables. It's called the lying score. And for Wirecard, it was a negative number, and it was by far the lowest. It's more than 2 standard deviations away from the mean of 1.295 is the typical score, and a negative score is really bad in terms of evidence of lying. And this was the year before the Wirecard fraud was revealed. So that's what was interesting. So not directly related to our integrity score, but because we did this or started collecting some of this data, we found that very interesting side note. I think there's more to do here. Again, I think machine learning is going to do a better job than what we can with mechanically with dictionaries or manually with dictionaries, but more work needs to be done. Yeah, so I think I'll stop there.
Thanks, Shane. And I think, well, if that's actually something we could use in the audit practice, that would be, of course, very relevant to us. So if we are able to maybe flag clients where there is a low perceived behavioral integrity that may help us in double check our audit files to see whether we have missed anything.
Yeah.
And maybe a last comment, just I see in the chat, and then I'll hand it over back to Jan. So Anil says that's a very fascinating study, and it might also be interesting to see the consistency between what they say via less formal channels of social media, such as tweets, and in more formal channels like shareholder letters. And I think that's a nice comment that fits into the context of our today's lives.
Oh my gosh, that's a great study. I think if you just do Elon Musk and study what he says on social media versus what his integrity score is, and see well, I don't know what kind of outcomes you could use with that, but yeah, that is very interesting. I agree.
Thanks, Shane, for answering all the questions. I hand it over back to you, Jan.
Well, thank you very much, Marnix, for these intriguing questions that you asked.
Yes.
And also helping the audience to ask their questions. And thank you, Shane, for this very articulate and very fascinating presentation.